So you want to save for your child's education. But here's the million-dollar question. Which account gives you the biggest advantage? A 529 plan or a Roth IRA? Choose wrong, and you could pay more in taxes, limit your flexibility, or even put your retirement in jeopardy. Choose right, and you'll give your kids a head start without sacrificing your own future. Today, I'll show you how both work, when each makes sense, and a strategy that might help you win on both fronts. So let's get started. Most parents jump into college savings plan without considering the ripple effects. They may open a 529 plan because that's what everybody else does, without realizing that non-qualified withdrawals come with taxes and penalties. Others avoid a 529 completely, thinking a Roth IRA gives them more flexibility, only to discover that they have shortchanged their retirement. The truth is, each option has a powerful benefit, but also key trade-offs that could cost you thousands if you're not careful. Now, here's a side-by-side comparison. A 529 plan, also called the Education Specialist. It has a tax-free growth and withdrawals. Earnings grow tax-free, and withdrawals are tax-free for qualified education expenses like tuition, books, and room and board. Now, they have higher contribution limits. Many states allow well over $300,000 in lifetime contributions per beneficiary. Potential state tax deduction. Over 30 states offer deductions or credits for contributions. Now, the downside is use it for anything other than qualified education expenses, and you'll pay income tax and a 10% penalty on earnings. Now, let's look at the Roth IRA, the flexible contender. Retirement first, education second. Earnings can be withdrawn penalty-free for qualified education expenses, but they may still be taxable. However, there's more investment choices, usually broader than a 529 plan. It also has a double duty effect. It can be used for retirement if your child gets a scholarship, skips college, or decides not to use it for education at all. Now, the downside is the annual contribution limit is much smaller, at $7,000 for most in 2024, $8,000 if you're 50 and above and using it for college, but this could also leave you short for retirement. Now, let me give you a real-life story. I work with a couple in Ohio, Mark and Lisa, who started a 529 for their daughter with small monthly contributions. They liked the tax benefit, but didn't want all their eggs in one basket. They also funded a Roth IRA for themselves, keeping it as a flexible reserve. By the time their daughter enrolled, the 529 covered tuition for 3 years. The 4th year was covered by their Roth IRA contribution. No penalty and no scrambling for cash. Their strategy worked. They covered college and stayed on track for the retirement. Now, let's say you invest $25,000 when your child is 5 years old. By the age of 18, it grows to $50,000. With the 529 plan, withdrawals for qualified education expenses is 0 taxes and 0 penalties. Now, if you have a Roth IRA, withdrawals for a $25K contribution are tax-free, but the $25K earnings may be taxable if you're under age 59 and a half. This could mean thousands of dollars in taxes, money that could have stayed in your pocket. So let's look at the flip side. I had a client who decided to skip a 529 entirely. She pulled $20,000 from her Roth IRA for her son's tuition. The contributions were fine, but part of the withdrawals included earnings. That triggered a tax bill and lowered her retirement balance, which meant she had to save extra later to get that money back on track. Now, if you're looking at financial aid in college, here's something most parents don't realize. 529's assets count for the parent, which is better than counting in the student's name. The Roth IRA assets not counted in the student aid calculation, but withdrawals count as income the following year, potentially lowering your student aid package. Now, the key is to use both accounts. Fund your Roth IRA for retirement first, then direct extra savings to your 529 plan for education. 2, start early. Even $100 a month from birth can grow into tens of thousands thanks to compounding. Number 3, review annually. Tax laws, financial aid rules, and your family's needs can change, and so should your savings strategy. Number 4, consider state incentives. If your state offers a deduction for 529 contributions, that's free money towards education. Now, your child's education is important, but so is your retirement. The best plan balances both, keeps your taxes low, and preserves your options. If you're ready to build a savings strategy that works for your family, I can help you run the numbers and walk through the what-ifs so you can save smarter. And don't stop here. Watch the next video for more tips. Financial disclaimer. This content is for educational purposes only and should not be considered tax, legal, or investment advice. You should consult with a qualified financial advisor or tax professional before making any decision regarding 529 plans, Roth IRAs, or other investment strategies. Investment performance and tax rules can vary based on individual circumstances and changes in the law. So thank you very much for listening today. And as I like to say, call Jay today.